Hi everyone, let's go over my bullish and bearish Elliott Wave scenarios on Bitcoin, starting on the low time frame with the bullish scenario where we are looking for wave 5 to the upside after wave 4 has ended. Wave 5 is an impulsive structure where we are then looking for 5 waves to the upside, which then results in this scenario over here where we have a finished wave 1, finished wave 2, potentially a finished wave 3, and then looking for 4 and a 5 to the upside. Most common target for wave 4 is between the 0.236 and the 0.5 Fibonacci, taken from the low of 2 to the high that we have at the moment, giving us a target area between 45k and 44k, with the invalidation being the 0.618 at 43.5k. More locally, we are then looking for a corrective structure to the downside where, based on this scenario at the moment, a potential double zigzag is on the cards, where we then have a zigzag number 1 over here, a 3-wave structure where wave B hit the 886, which is a common target for a wave B, but a rare target for a wave 2, which increases the probabilities that this move to the downside is a wave C, also ending on top of the 1-to-1 and the 1.236, which is the common target area for a wave C, taken from the high to the low of A to the high of B. Then for this wave X, we are looking for a retracement to the upside between the 0.5 and the golden pocket, where preferably in a double zigzag, wave X is not hitting the 0.7, but at the moment it rejected at the 0.5, where then we are looking for a continuation to the downside in another zigzag ABC for this wave Y, and then a double zigzag WXY. Most common target area for this wave Y is between the 1 and the 1.236, taken from the high to the low over here to the current high that we have, which is a target between 44.4k and 44.1k. Now, what is also important here is the vertical lines on the chart. These lines are Fib times, and these are taken from the high of 1 to the low of 2 to the high of 3. If we are looking for this 1, 2, 3, 4, 5. So they're taken from this pivot to this pivot to this pivot to compare a wave 2 with the potential wave 4. Most commonly, a wave 4 takes more time to form than a wave 2. So usually you would expect a potential wave 4 to finish after this 1-to-1 over here. That is not a rule, it's not a requirement, it's just more of a guideline. The 1-to-1 is sitting at tonight 11:30 p.m. Central European Time. And there you can see I have multiple lines on the chart varying in color, where for a wave 4 it's absolutely normal to be 1, 2 or 3 times longer than wave 2. If it is 4 times longer, we start to look for other scenarios as well. 5 times is unusual and 6 times is usually invalidated. If we look at the bearish scenario, then we are looking for this move to the upside as a 3-wave structure in an ABC, and then a bigger flat structure ABC over here, where for a wave C, we're looking for a 5-wave impulsive structure to the downside, where the most common target for wave B is between the 1.236 and the 1.618, which is between 45.3k and 46.6k, which is an important area because we also have over here a yearly level at 46.2k and a daily at 46.6k. On the micro, we are then looking for a 3-wave structure to the upside now, right? And then a wave A, which was a 5-wave structure in a diagonal, a 3-wave B in a zigzag reaching the 0.5 Fibonacci, which is a common target for a wave B as well as a wave 2, and then we are looking for a move to the upside in a wave C. Now, when I look at the sub-degrees of this move to the upside over here, I would count it over here, and then a wave 1, 2 in yellow. We have a 3 looking for 4 and a 5. Target area for this yellow wave 4 is the 0.236 to the 0.5, taken from the low of 2 to the high of 3, which is between 45k and 44k. And then inside this yellow wave 3, we have the purple 1, 2, 3, 4, 5. And then inside the purple wave 3, we have 1, 2, 3, 4, 5. Most commonly, wave 3 is the most extended wave. Now, what is not too nice for this scenario is that this wave C is very, very extended. You can see the 1.618 and the 2.618 on my chart over here. And these are trend-based fib extensions taken from the low to the high of A to the low of wave B. A common target, I suppose, for a wave C still is the 1.618. Most common is the 1 to the 1.236, by the way, which is down here where this pivot was made. The 1.618, little less common, but still common. But moving past the 1.618 is quite rare, especially the 2.618. So it does lower the probabilities a bit for this particular scenario. In this case, the vertical lines on the chart are taken from the high of 1 to the low of this wave 2 to compare this yellow wave 2 with the yellow wave 4 that we have over here. Same rules over here where, again, wave 4 can easily be 3 times longer compared to your wave 2 over here, but we don't really like to see it move to the 5 or the 6 times, right? So we're going to observe this range over here tonight as well as tomorrow. Now, if we look even more locally and we would say, hey, could this move be finished, right? Could wave C be in and we're going to be moving to the downside, basically the most bearish scenario, then we have to look for 3 scenarios to the downside, either an impulse, a diagonal, or a double 1-2. For an impulse, we are looking for a 5-wave structure, 1, 2, 3, 4, 5, but we don't want to see overlap over here, which we've seen here on the chart. So that is not something that's ideal. Preferably, you would have had a 1, 2, 3, 4, 5, no overlap between 4 and 1, as that is not allowed in a classic impulse. So because of the overlap here, we have to think about either a diagonal or a double 1-2. In a diagonal structure, we are then looking for a wave 1, 2, 3, 4, 5. But what is not ideal in this scenario is that this wave 3, and then a 1, 2, 3, 4 looking for 5, that wave 3 is longer in price than wave 1, which really reduces the probabilities of a contracting diagonal, and an expanding diagonal is very, very rare and never has the highest probabilities. And if we then look at a double 1-2 and a wave 1, 2, 1, 2 continuation to the downside, then in this case, the first wave 2 retraced to the 886 taken from the high to the low of wave 1, which is a rare target for a wave 2, common for a wave B, which lowers the probabilities. This move to the downside is another wave 1, 2 for eventually a bigger 3, because the probabilities are lower. This is a wave 2. Now, if we look at this range, then we are now above the range, of course, and we have important support below us, which is this white box over here, sitting between 44K and 44.4K, which is also in nice confluence actually with the support area for a potential double zigzag here in a WXY. It also has to be said that if price does move towards the upside and hits the 07, then either we're going to be looking for a longer sideways structure and then a WXY, or an A, B, and then a wave C to the downside, if we at least are looking for a bigger wave 4 to form here, or we have continuation where we get a bigger wave 4 later. But it is nice that we do have some confluence between the white box and a potential wave Y target over here. And also in the more, let's say, bearish scenario of an ABC, we also have the white box in confluence with this wave 4 target in yellow, the 302 to the 05. So currently this white box is very nice indeed. We are finding resistance against the monthly. You can see on the 4 hour, no candles closed above the monthly level, 45.5K. And above the monthly, we then have the yearly and the daily as well for resistance, right? Important support down here. We don't want to lose this level. Important resistance right above price. Now, regarding CVD divergences, yeah, we do have a little bit of bullish CVD divergences, but preferably I would see new bullish CVD divergences on the right side of this high, where also price does not touch the 886 Fibonacci. Now, this pivot is on the left of the recent high, right? And then it has bullish CVD divergences with the low over here, higher low in price, lower low on the CVD. However, preferably I look for CVD divergences on the right side of the high as mentioned. So preferably I remove this and then I look at CVD divergences here. But the problem with this CVD divergence is the retracement we had to the downside, because if we take a fib from the low to the high, the 886 has been touched and we are now moving down, almost hitting the 886 for the second time, increasing probabilities of a move to the downside. The fact the 886 has been hit here also increases probabilities this move up is a wave C or a wave Y, which increases probabilities to then later come back down and take this low over here. And if we then look at the probabilities of the different scenarios, then on the low time frame, when we look at this range, the probabilities are a bit higher for this move to the upside to be an impulse instead of a wave C, because a wave C is then very, very extended. And for an impulse, we are then currently looking for a wave 4 to form, after which we then expect another high to be made in in a wave 5, and then we take it from there, because we do have important resistance above us, the yearly level at 46.2k. On the micro over here, we are then also looking for a wave 4 to form, and more locally based on the local market structure over here and the little 886 touch that we have, probabilities are higher. We're still going to see a bit lower prices before then potentially that return for a move to the upside, where we have the important support below and the important resistance above. I hope this video was valuable and helpful to you. Please check out the most recent educational video I've made about the best trading indicator you can use in my opinion, which is the CVD. And for now, thanks for watching and subscribing, and I'd like to see you at the next one. Bye bye.